So you started in Citibank, or actually no, before you started at a place before Citibank, right?
Oh, long before Citibank. I actually started as an economist at a bank that no longer exists named Manufacturers Hanover Trust Company. And back in the 70s, when the dollar was first floated by our friend Richard Nixon, it was a big deal because nobody knew how to handle foreign exchange, a variable foreign exchange. We had fixed exchange rates at the time, and nobody knew how to handle a floating exchange rate. And I had actually done some work on exchange rates when I was in college. And so when they said, does anybody know anything about exchange rates? I said, yes, I do. So I became a kind of an expert. I started off as an economist and in dealing in foreign exchange, but primarily on the credit side, because nobody knew how to buy and sell goods in international trade with floating exchange rates. And very quickly, this is in the late 70s, very quickly a whole industry grew up out of nothing. And that's why it's so amazing for people like me who were there at the very beginning to see how large this industry has grown. Now, to tell you the truth, even back in the 70s, it was clear to me, and I don't think I was particularly visionary, that there would at some point be a retail market for trading foreign exchange because it's obvious that this is a wonderful asset class to trade. It's trended. It has a lot of very fine characteristics, which I'm sure the audience knows all about. But back in those early days, our chief goal was to advise major multinational corporations on how to hedge their exposures. And we did have some accounting problems, too, because the Accounting Standards Board had really stupid ideas about how to account for things. In any case, all of the major multinationals hired the banks, and by this I mean IBM, Coca-Cola, General Motors, everybody. They all hired different banks to be their foreign exchange advisor, and I became a foreign exchange advisor in 1979 at a place called Brown Brothers Harriman, which was a very Tony, high-class kind of a place. And we would try to forecast exchange rates based on economic theories. The problem was it didn't work. It was, in fact, a horrible failure. And that was the time when I began to get interested in technical analysis, which was really very much in its infancy in terms of being able to find books or articles or written materials. Technical analysis has actually been around since the turn of the last century. Charles Dow, who's one of the founders of the Wall Street Journal, was the very first guy who had a theory that used anything that we would call technical analysis today. But most of the people who were using it were using chart patterns, by which I mean things like head and shoulders and double bottoms and simple support and resistance, those kinds of things. And we did not really have the kind of math-based technical analysis that we have today. Well, then something else happened, which was the advent of the personal computer. And the minute everybody could get their hands on a PC, the industry absolutely exploded. So like a lot of other people, I became an indicator junkie. And, you know, the minute you heard about a new indicator, you couldn't wait to run right out and try it on your securities and see if it worked and how it worked and how often it worked and how much money it made for you and what were the risks of using it. And so like a lot of other people, I ran through just about every indicator ever invented. And I invented a few of my own, but certainly not anything terribly famous or anything like that. Subsequently, I stopped being an indicator junkie and became a lot more interested in really what you might call market sentiment. And that happened in kind of an interesting way. I was asked to write a book called Technical Analysis for Dummies, you know, the yellow books. And in the course of writing it, the way you write a dummies book is the editor, you write a bunch of things, and then the editor asks you questions. He's the dummy. And you have to be able to explain to the editor what something means in words of one syllable. And so if I've written 15 pages on support and resistance lines, he makes you go back and define every single word that you've used, and that creates a previous chapter. So by the time you're done, you don't have the book you set out to write. You have the book that appeals to a dummy, which is actually it's why the Dummies franchise is so powerful, because you really are explaining everything. In the course of writing this book, I was trading, of course, at the time, and in the course of writing the chapter on the components of the bar and the candlestick chapter, I made more money in that 6 weeks than I had ever made in a year before. It was astonishing. And that led me to a deeper understanding of how these markets move. Of course, I only trade foreign exchange. I very seldom do anything in equities anymore. And that changed my trading methodology to be a lot more sensitive to the players, to the actual other traders in the market. Just to give you an example, when you have a close at the low, and we had one yesterday in our market and one again today, either at or very close to the low. Well, that tells you something. It means that people just don't want to hold this thing at any price. And when you have a very tall bar, like we had yesterday and again today, it means that sentiment is very strong. So you have a selling sentiment and a big, fat, strong one, too. And because we are a trending market in foreign exchange, we very definitely want to get on that bandwagon. We want to be a seller, too. Now, because the bars are so big, we have to worry that there'll be a reaction against just such a big move. Some people will say, oh, this is overdone, this has gone too far, and say it back. And we do have to worry about that. But as trend followers in the foreign exchange market, we want to go with it. And here comes, I think, probably my first point. Yes, you have to know the fundamentals. You just have to. It's like opening a restaurant without being able really to cook or understanding cooking. It's just a basic thing that you must have. But you can't trade on it. You have to trade on indicators, and in order to trade well on indicators, you have to understand the market sentiment that is behind them. And for me, what works for me is not only the indicators themselves, but the underlying meaning of what people must be thinking to have created those bars, like the extra long bar, the close at the low, and other things like that. And so I've kind of integrated over these many years the fundamentals and the technicals and what I'm calling here market sentiment of the major players. So it's really a comprehensive view of the market that has many components and moving parts, so to speak. So that is kind of the background. And later on I will be showing you some of the indicators that I use. And if you don't understand these indicators, they're all very, very basic things. You can Google them and find them on Investopedia or many, many websites. And in fact, I've just completed a revision of the Technical Analysis for Dummies book, and there will be a new edition coming out, we think, in January. And in the course of doing that, I Googled a lot of these terms just to see how many hits would there be on something like stochastic oscillator or, different terms, different indicators, different concepts. And there are hundreds of thousands. And that, of course, can get a little bit confusing. I did find, by the way, that Investopedia is pretty good. I didn't find, wrong information at Investopedia. But, of course, I want you all to run right out and buy Technical Analysis for Dummies,
right.
Especially in January when it comes out.
We look forward to that.